guy. Please welcome into the show America's accountant, Mr. Dan Geltrude. Dan, thanks for coming on. Has the Fed lost our trust?
I think it's lost a lot of our trust. I mean, what little they have left, let's see if they could salvage it. You know, when you think about, oh, the Fed doesn't have credibility, who cares? Well, you know, it's not that simple. It actually matters a lot, particularly how the stock market is going to react, which is where the vast amount of the nation's net worth is, right? That's where we have our value. So let's break it down a little bit. Right now, the Fed is giving a lot of mixed signals, Scott. Right now, the Fed likes to say we're data dependent, right? So they're not looking at emotion or anything. Okay, good. But, you know, they pivoted while inflation was still sticky. Why? What happened to the data then? So that creates confusion. Then you have the markets, you know, doing a front run on the Fed, right? Because when all this pivot talk started, financial conditions eased, right? And then stocks rose, bond yields dropped, and that makes it harder for the Fed to do their job. And then, of course, you have this sticky inflation data, right? So you have a reacceleration of inflation in a lot of areas, right? So if the Fed cuts, the signal there is that they're willing to tolerate more inflation.
Exactly.
Well, what does that mean, Scott, related to, hey, 2% or bust? And what you just said in your monologue there, you know, the prediction is 3.3. We have a disconnect. The stock market doesn't like that.
So you nailed it on the head, and you and Jim Muriel also would probably agree on this, is that given their druthers, I like that word, I think the Fed would be much more comfortable with inflation between 3% and 4%, because we have a debt problem in this country, and we need to find a way to get out of it, and that's one of them, right? Inflate our way out. So it's not going to help us, on one hand, to drive inflation to 2%, because then we're going to really make that debt problem, on one hand, harder to get out, but on the other hand, the debt service is a lot better. That's why I keep saying this is a difficult situation for the president and his guys to be in, because you got to hit that ball over the trees and under the bush. I mean, that's not that you can't do it, but it's just going to be a very, very difficult golf shot. And then I'll end on this one. Again, to your point about this pivot that we've had, since we've had the last CPI, the last PPI, and we had the two PCE numbers we just got last Friday, they're all showing that inflation is bubbling up. It's not going down per se. And if that's the case, how does the Fed still entertain 2 rate cuts? I mean, it makes me feel like they see something that we don't, which could be bad for the stock market, or they're just playing words to try to appease both sides of the fence.
Yeah, and let me throw something else in here too, Scott, where it's going to start getting tough. President Trump has been focused in on a number of other things. Obviously, tariffs are the headline of the day. But when that simmers down, and it will at some point,
yes.
Trump is going to start to focus in on interest rates. And he's going to be all over Jay Powell about lowering interest rates. So now, can Powell withstand that and say, no, we're going to be data driven? Or is he going to lower those rates? And what I say is, although I do like low interest rates, when you start to lower interest rates, Scott, you incentivize the federal government to borrow more because it's cheap money. And then, of course, at some point, rates come down or rates go up. Now our debt problem becomes even larger. So you're right, this situation, there's no easy path out of this. And a lot of it will be determined by which way the economy goes. Mm-hmm. Because if things go sideways, Scott, we could be in a world of hurt economically.
Right, and so you can see why he wants rates lower, right? It's going to make the budget deficit easier to get over, and also it's going to help him inflate his way out of this, because it will spur on inflation, right? But at the same time, the general electorate is going to have to pay higher prices, and he doesn't like that. So he's also, on one hand, he wants rates lower because he thinks he can inflate his way out of it by, paying his debt back with cheaper dollars, and also making the debt service on an annual basis better. But on the other hand, he's got to hope and pray that what he's doing with Doge and a few other things come through as deflationary tactics that can offset the inflationary things that he's doing on the other hand by keeping rates low. That's like a parlay that you got to hope comes. That's like 7 or 8 things that have to come through for your parlay to win. Not to say it can't happen, but it's going to be tough.
Well, and Scott, let me throw one more thing on that fire. He's talking about tax cuts. Now, if you're cutting taxes, assuming the growth of the economy will make up that difference, meaning more people will be able to pay in because everybody's making money. But if you don't get that and you have tax cuts and you have a reduction in revenue coming into the Treasury, now your debt problem didn't go away.
Right.
So that's another variable in this.
Yep.
Tough scenario.
You're right. Maybe he does need a third term to look after it. I don't know. We'll see. All right. Thanks very much, Dan. Dan Geltrude coming to us from Nutley, New Jersey. Always has something great to say. America's accountant.